U.S. Treasury yields continue to remain at the low end of the range and are nearing, they're very precariously sitting just above a breakout, which would launch prices higher and yields lower. We're at the bottom of that 275 10-year note. We haven't really seen, an aggressive move to get through it. Yes, we've been sort of hovering in that area and waiting for some kind of action. But let's face it, the technical trade here, it's been very one-sided. It's been all buying in treasuries. It's been slow, but it hasn't been as certainly as fluid as the stock selling has been. But certainly we've seen more buyers come in here as the uncertainty is on the rise, and the technicals are all telling you that if we get through 275 yield, it's likely going to get worse before it gets better for shorts. And right now, those are the ones I think the market's sort of waiting on, those leverage funds that remain net short and are adding to those shorts with the idea that they can mark risk at that 275 level. I think a weekly settle below it in yield. You'll probably see some of those net shorts start to get out. Market volatility in Treasury side, very high, very well bid, especially going out day before a holiday. And I think that right now that's going to remain that way because we are precariously sitting, on the edge of the range, sort of on the edge of the neutral zone, waiting to see if we're going to go back up into the meat of the range that we've traded in over the last several months, or if we're going to maybe see a breakout here, and maybe there's something else out there. Maybe equities can't hold on. Maybe equities can't continue, stop the bleeding. Maybe there's something else going on in risk assets, the uncertainties in Washington and trade tensions and whatever you want to call it. Those are all adding to the fuel. And if you look at first quarter, things don't look any real clearer when you add in what's going on between the UK and the EU and Brexit. So I think ultimately right now we're going to see Treasury volatility remain elevated, probably more because equity volatility is elevated, because equities are pretty much leading this charge in volatility space. So as we see equities higher in volatility higher in equities, it will remain higher in treasuries. And lastly, let's talk about the Mnuchin meeting. Okay, so he calls all the banks together. He says he wants to talk about liquidity and issues that may come up. Everything's fine, they said. Remain calm. Markets are all fine. Remain calm. I was once told, never believe anything a Treasury Secretary or Fed official tells you unless they first deny it. And I think that it's a little bit of a joke, but I think ultimately, why gather everyone the day before a holiday while you're on vacation to tell you everything's fine unless you need them to hear it? And it didn't really help equities today, and likewise, treasuries continue to rally. So I think that right now the risk off trade continues. Anything that meeting was supposed to do or maybe was perceptually going to do, it didn't. And we'll have to wait until Wednesday now because of the Christmas holiday here in the States to see if there's going to be any fallout. So ultimately, he had his reasons to have that meeting, but I don't think it had the intended consequences. And the markets right now still remain a flux. Equities continue to get hit. Volatility is higher, and treasuries are going to be the beneficiary of that. Long treasuries are going to be the beneficiary to that as we hover above this 275. But look out, if we get below it on a weekly settlement, it's really going to energize the buyers, and we're going to start to see some real movement.